Happy Red Friday, everybody. This is Eric with Low VA Rates. Today, we're going to put you into preparation mode. I want to talk to you about how you can prepare for your very first call with a lender, okay? There's nothing better than being prepared. When you reach out to a lender, hopefully low VA rates, but when you reach out to any lender and you're not ready for that conversation, you could be wasting a lot of their time and your own time. Now, buying and refinancing a house, it's a big decision. As you know from watching our videos, it involves a lot of information. In today's Red Friday video, oh, by the way, before you forget, over here, you need to subscribe, you need to follow, you need to do whatever you can by making sure each time I come out with these videos or anybody else on our team does, you're notified. But today we're gonna cover some very important stuff about the mortgage industry and certain lingo that will be helpful for you so that before you make that first phone call, you've got all the information you should have ready and some tips to help you get the most out of that first phone conversation. Now, there's 6 terms we're gonna go over today that I want you to know. Okay, 1, 2, 3, 4, 5, and 6. I'm gonna put 6 up there right now in case I kind of get scatterbrained. I don't forget, I gotta give you all 6. Now, there's tons of new terms that you're gonna encounter during the mortgage process. There's really only a handful that you're likely to encounter on your very first phone call. So let's talk about those. Number 1, pre-qualification / pre-approval, okay? So pre-qual, pre-approval, approval. I don't know why I always stretch like that. I should just walk over there, but I don't like having my back to you guys for too long. Now, pre-qualifications tend to be less rigorous. You simply are going to give the lender some basic financial information, and they don't need to go out there and verify any of its accuracy. A pre-approval, however, requires the lender, in this case low VA rates, to verify that financial history and that employment history, as well as perform a hard pull on your credit. Okay, that's the difference between the two. But despite the extra steps, we typically recommend a pre-approval over a pre-qual because the pre-approval really carries the weight and is valid for you to go out and start looking for a home. Number 2, hard pull, okay? Let's see. As a hard pull, we're talking about on your credit. Hard pull on your credit. Sometimes the hard pull is also referred to as a hard inquiry, but either way, a hard pull or inquiry on your credit means that we're literally going to request a copy of your credit report. A hard pull is different than a soft pull in that we are requesting it so that we can evaluate your risk in order to determine whether or not we're willing to lend you money based on that risk. It's also different in that that hard pull can lower your credit score by a few points. Now, I don't want you to worry about that. Don't worry about that. It's not going to impact anything. It used to in years past, but then certain legislation and laws were created so that lenders could not, have a negative impact on your score just by doing a hard pull. Now, if different lenders start pulling your credit, hard pull, because you're out shopping around and you want the best lender, within a 45-day window, it's going to all be treated as one inquiry. But you're going to want to do all that shopping and searching for a lender inside of 30 to 45 days so that you don't have to worry about each of those hard pulls affecting your credit. Third term I want you to really be familiar with is DTI, or debt to income ratio. Okay, it's a fraction. I tell you what, I don't know if you guys have kids, but fractions, I'm gonna get off the topic here for a second. Remember, that's why I listed this off, because sometimes they go that way. I was helping my daughter do homework the other night. Forget it when it comes to fraction, addition, subtraction, way too hard. That said, ratio will be a fraction. A debt to income is the following. It's a financial calculation that takes your recurring monthly expenses and divides them over your gross monthly income. So it's total expenses for the month divided by total income. Most lenders use what's called a back-end debt-to-income ratio, since it also includes your projected mortgage payment and all those other monthly debts. Now, these other debts include things like your credit cards, your car loans, your student loans, alimony, potentially some utility costs. For things like credit cards, the amount used in the calculation isn't how much you pay each month. or even the balance. It's the actual minimum monthly payment due. So let's say I'm looking at your credit report. You've got a MasterCard with a $4,000 balance. There's a $40 a month payment. Even though you're paying $200 a month because you're smart, you're good with your finances, and you want to pay it off fast, when we're calculating your debt to income ratio, we're going to use the $40 a month payment, not the larger payment that you're making each month. Now, number 4. I said this, but I meant this. Number 4, residual income. Now, I know that it's mainly veterans that watch our site. Residual income is something that's specific only to VA loans. It's unique to VA loans. So if you're watching this and you're not a veteran, or you're not going to use your VA benefits to buy a home, you can still listen and learn, or you can fast forward a little bit, because this is unique to VA loans. And it's a financial calculation that also, like the DTI, involves your debts and your income. However, in this calculation, all of your debts get subtracted. Sorry, they get added up. All your debts get added up, and then they get subtracted from your gross monthly income. So like the DTI, the residual income calculation includes the same things: your car payment, student loan payments, credit card bills, alimony, child support. Here really is where the utility costs come into play on residual income, and that new mortgage payment if you're buying a home, or that new mortgage payment if you're refinancing. So after your residual income gets calculated, it then gets compared to a kind of like a table that the VA provides us that says, based on your geographical area, based on your family size, and the loan amount that you want to borrow, do you meet the residual guideline, the residual income guideline, or not? And I just want to give you a quick example. Let's say you make $5,000 a month gross. That's not what hits your checking account. You know, of course, Social Security comes out, and your taxes come out, maybe some health insurance comes out, but your gross income is $5,000. Then you've got your withholdings that I just talked about. Withholdings, okay, you guys got that. Then your debts that we talked about. Let's say when it's all said and done, you have $3,000 left over. Your residual income would be $3,000. You started with $5,000. You took out some withholdings and some taxes. You paid your car payment. You paid your mortgage payment. You've got $3,000 left in residual income. That's how that works. Now, let's talk about the 5th of these 6 terms I want you to learn. Loan estimate, also referred to as the LE. Okay, the LE is the loan estimate. This is likely to come up sometime in that first phone call. This is a formal document that the lender gives you. The government requires this, by the way, and it provides key information about the terms of your loan, the interest rate, the annual percentage rate, or the APR, and then an entire itemized list of other fees. This document is one that you're going to want to use when you start comparing lender to lender, or offers to offers. We have lots of videos on how to effectively shop for a mortgage. If you don't have a loan estimate, you're not accurately shopping for a loan. Now, the final thing I want you to talk about, or I want to talk to you about today, is the APR, or the annual percentage rate. Speaking about the APR, this handy little number is super, super important when you start shopping lender to lender and trying to figure out who's going to give you the best deal. Now, keep in mind, the interest rate and the APR are not the same thing. Basically, an APR is both a combination of your interest rate and the fees or closing costs that are associated with getting that rate on that loan. Now, when you're comparing offers from different lenders, make sure you're comparing the APR to get the most accurate look at what that loan is costing you. So let's talk about this basic information that you should have ready when you're shopping. What's your credit score? Okay, if you know a ballpark area of what your credit score is, that's going to help you get a better idea of what rates the lenders are offering you. Get a copy of your DD-214. That's not necessary on every single VA loan, but if you don't automatically come up in the VA system, that DD-214 will allow us to do some of that legwork for you to determine that you're eligible for a VA loan. That's what that helps us for. You're going to want to have your basic financial documents ready. We've got videos on this topic, so I'm just going to fly through tax returns for the past 2 years, your last 2 years W-2s, the 2 most recent months worth of bank statements. Have all of that ready, because on the call, your loan officer is likely going to tell you a few other things you need, but if you have those things, you should be good to go and be on your way to a pre-approval right away. Now, finally, 3 tips for you to maximize the value of this call. Tip number 1, review a free copy of your credit report before you start making these phone calls. That's going to allow you to see if there's any negative information on there that should be cleaned up, or maybe it's even erroneous before you start the home loan process. Make sure your name's spelled right on your credit profile. Make sure all the debts are yours. Take care of all of that up front. Number 2, make sure you have a rough idea of what your budget is. There's all sorts of places to go and work on a budget. Just go to Google and type in home buying budget. We have tools on our website. It's underutilized, but there is a VA home loan purchase calculator where you can go in there and it plugs in all this stuff and it tells you whether or not you're going to be able to afford the size of a home or loan that you want. And number 3, just make sure you've got a list of questions ready. I would ask, how many VA loans have you done? What kind of closing costs do you guys generally charge? What's my timeline for closing? What do interest rates look like? What do interest rates look like right now? Do you have a VA realtor that you could put me in contact with? These are all sorts of things that are going to make you more prepared for that initial phone call. And as always, I got to tell you, the last thing I really need you to leave this video with is make sure Low VA Rates is one of those lenders that you call. We want your business. We want to compete just as much as we want you to go out and shop around, and we are dedicated to winning your business. I hope this video was helpful. Can't wait to talk to you or have one of my loan officers talk to you about your options for VA mortgages. When you're ready, thanks for wearing red. If you're not, go put a red shirt on. We'll see you next week, same place, same time.